In this week's AMT Insight, I'm going to talk about how can the tin market recover from the pandemic era shortages that we've seen over the last year or so. Now, what I'd like to say initially is that if you're finding the content that we're putting out interesting, then I really strongly encourage you to follow Amalgamated Metal Trading on LinkedIn and Twitter if you haven't already done so, and that will help us measure some of the engagement we're getting with this content, but also provide you with updates when we put new content out. So win-win really, and I'd really strongly encourage you to do that if you haven't done so already. Now, in terms of the real driver at the moment of significant supply tightness and persistent supply tightness in the tin market, really it's considerable constraints, ongoing constraints on producers, particularly in Asia, and that's about 2/3 of global mine output for tin. And I think the virus is continuing to have quite a significant impact there. So you've seen a strict national lockdown in Malaysia that had impacted the Malaysia Smelting Corporation, third largest producer in the world. They had to shut their plant down. You had in Indonesia, continued constraints on workforces within plants, for example, because of ongoing COVID restrictions. And there's further risks to supply there from rising cases in Indonesia. And in Myanmar, they've had shortages of workers because they can't get the workers over from the Chinese border, again, because of COVID restrictions. And you take that forward to China, then in the last week, we've seen that Yunnan has had rising cases of the Delta variant as well. And that's going to cause issues with potentially shipments of ore from Myanmar, but also perhaps local production from smelters, which is the key region really, Yunnan, for Chinese tin output as well. So lots of risks and continued constraints and limitations really there in terms of supply. In terms of the longer term outlook supply, ITA are projecting potentially 40,000 tonnes of extra additional annual capacity by 2025 from investment in large scale projects. Now, I think with prices where they are at the moment, 30,000 plus, that's definitely something where we perhaps see some more investor interest coming into the space. I think the risk is also that with prices at those decade highs, you might see further surges in artisanal production, like what we've seen in recent decades. You have Brazil and Malaysia, Southeast Asia, Thailand, and then you saw the emergence of Indonesia in the early 2000s. And then more recently, in the last kind of 5-10 years, you saw Myanmar emerge as a really significant producer as well. So there's lots of risks there in terms of the potential for additional supply from perhaps unexpected sources with prices at current levels. Now, in terms of tin use, the other side of the coin really for the tin market, well, demand was really very strong in 2020, considering the slowdown in economic growth. So it was up about 1% as very strong demand from consumers for things like home appliances, electronics, as they were working from home. That really offset the slowdown that we saw elsewhere. And I think with also last year, you saw China performing quite well. That kind of kept things going quite well. But now into this year, we've seen Chinese economy normalizing a bit, some of this stimulus policy being rolled back a little bit. And meanwhile, the US and Europe really sustaining that strong demand growth. I think as we move into the second half of this year, I think we're likely to see a continued normalization of the Chinese economy. That could weigh on tin demand a little bit. And also consumers are likely to switch some of their spending more towards services. So leisure, transport, holidays, going out, rather than what the goods they were spending on before. So maybe that could weigh as well. But I think in terms of the longer term post-pandemic outlook, it's still positive. I think with the ITA projecting a 3.5% annualized growth in tin demand through to 2025. And that's really been driven by the very strong trends in the electronics sector. So that's demand that we're likely to see from all these touted areas like electric vehicles, renewables, infrastructure, 5G, the Internet of Things, and more just this underlying trend towards more electronics in our daily lives. So that's something that we see maintaining quite strong growth over the next few years. The other key theme to pick up on is that Chinese refined tin exports have really picked up the last few months, and that's really been quite a significant difference to the largely import-focused relationship they have with the rest of the world over the preceding couple of years. And the reason for that really has been that Chinese supplies has been relatively strong compared to, again, this slowdown perhaps in the Chinese economic growth that we've seen. I guess going forward, the risks to that are, I guess we could see that demand slowing more, but there are still those risks there, like I said, with the cases in Yunnan to Chinese supply and the slow and limited supply of concentrate from Myanmar as well that could impact Chinese supply. So there's still risks there for why that net export situation might not perhaps persist for too much longer. if those risks are realised. Now, finally, and I think probably the most important point to make with the tin market at the moment, there are all these uncertainties on supply and demand, but I think the situation is that, in a lot of other metals, that they have inventory there to absorb those kind of day-to-day or month-to-month fluctuations in supply and demand. And I think we're getting to a very critical point in the tin industry at the moment where you don't have that inventory either on exchange, producers, consumers, traders. The inventory levels across all bases really at quite critical levels. And I think you see that quite clearly reflected in the low LME inventories and the very extreme and sustained extreme cash to 3-month backwardations in the LME spreads as well. So, and I think what are the implications of that really are, well, let's say we have some more supply disruption in a month's time, let's say another mine goes down, how well can the market absorb that? I'd argue not. Probably the scope for the tin market absorbing those kind of impacts has become more and more limited. And what's that going to mean? It's going to mean more volatility in spreads, more volatility in prices, perhaps far higher prices under very significant scarcity conditions. And I guess we talk about the longer term outlook for the tin market, and the ITA, based on the supply and demand trends that they've talked about, projecting continued deficits in the long term, really. And I guess, again, the issue is how do you sustain those deficits without the inventory there to draw down to do that? And I guess the result of that really in terms of the market reaction, the price reaction, is either going to be higher prices, either to incentivize that new supply or to, discourage demand through substitution or through, reduction in consumer spending, I guess, ultimately, if things get too expensive. And then also there's the macro risk as well, so is demand going to be impacted in other ways? So could there be a financial, monetary tightening, fiscal tightening, or other economic shocks that could soften demand as well and maybe bring them back into balance? But overall, I guess the key takeaway message is the projection is that they are at the moment is that supply and demand, production and consumption aren't going to be balanced. The inventory isn't really there to sustain the deficits that are being projected, and that the market is going to have to adapt very rapidly to bring the production and consumption back into balance.